Right now, oil infrastructure in Saudi Arabia is being hit. Flames are on camera, and the Middle East just shifted into a new gear. Iran has launched missile strikes across the region. Reports of US-linked assets being targeted are spreading fast, and a critical Saudi Aramco facility is reportedly in the crosshairs. And while most people are still trying to figure out, did this really happen? Bitcoin just slipped under $66,000, and the market erased billions like it was nothing. This is not a slow news day. This is a volatility event, and it's happening in real time. Welcome back. In this video, we're going to break down what happened, why the market reacted the way it did, and what the next move could look like across oil, stocks, and crypto. Stay with me, because the most important part of this story is not the missiles. It's the choke points. And once you see the choke points, you'll understand why one headline can move your portfolio more than a month of earnings reports. Here's the clean timeline. On March 2, 2026, multiple open-source monitors began flagging a coordinated wave of strikes across the Middle East. Not one isolated incident, not one drone, a pattern, multiple locations, multiple targets. And then the detail that instantly made this a global market story. Reports surfaced that Iran also targeted Saudi oil infrastructure, specifically Ras Tanura, often spelled different ways online, one of the most important oil export and refinery nodes tied to Saudi Aramco. If you don't understand why that one name matters, you're about to. Saudi Aramco is not just a company. It is the engine room of global energy supply. It is the largest oil producer on Earth. It is the oxygen tank for shipping lanes, airline routes, manufacturing chains, and national budgets. So when a headline even suggests Aramco's core arteries are threatened, markets don't wait for a perfect press release. Markets front-run fear. And fear moves faster than confirmation. That's exactly what we saw. Oil spiked, hard. Both Brent and WTI jumped roughly 7% in a single session. The kind of move you usually only get when supply risk is suddenly back on the table. And stocks didn't like it. S&P 500 futures pulled down fast as risk managers hit the same button at the same time: reduce exposure. Bitcoin didn't act like a fortress. It acted like a risk asset. It slid from the high $66,000 area down into the mid $65,000 range, dipping below that psychological $66,000 line that traders watch like a hawk. Now pause right there, because this is where most coverage gets lazy. They'll say, geopolitical tensions rose, investors moved to safety, and they'll move on. But that explanation is too clean, too simple, and it misses the mechanism. So let's do it properly. The real question is not, why did prices move? The real question is, what exactly did the market start pricing in? Because the market wasn't reacting to one explosion. It was reacting to a chain reaction. A chain reaction that runs through one narrow waterway that controls a massive portion of the world's energy flow. The Strait of Hormuz. This is the part most people hear about, but they don't feel it. The Strait of Hormuz is a narrow maritime corridor between Iran and Oman. It's small on a map, but it's enormous in consequence. A significant share of global oil shipments pass through that passage. Not some, not a little. A chunk so big that even a partial disruption can ripple through everything. Freight costs, fuel costs, inflation expectations, central bank decisions, and yes, crypto liquidity. That's the hidden wiring. So when tensions flare between Iran, Saudi Arabia, and US-aligned Gulf states, the market isn't just looking at today's damage. The market is modeling tomorrow's bottleneck. And bottlenecks are where prices go vertical. Now, why is Iran doing this? Because this didn't appear out of thin air. The escalation, according to widespread reporting and the narrative circulating in global coverage, accelerated after coordinated strikes involving the United States and Israel were described as preemptive moves aimed at degrading Iran's capabilities. Iran's response logic is simple. If you hit us, we raise the cost of the entire region. Not just politically, economically, strategically. And that's why this isn't only a geopolitics story. It's a pricing story. And money doesn't care about speeches. Money cares about flow, oil flow, capital flow, shipping flow. And when flow is threatened, price becomes a weapon. Now let's talk about what the market did and what the market is afraid of. Start with oil. Oil doesn't move 7% in a day because traders are bored. Oil moves 7% when the market senses supply risk. And supply risk has one word attached to it in 2026: Fragility. Because global supply chains aren't running with comfortable buffers anymore. Inventories are not infinite. Spare capacity is not magical. And energy infrastructure is not immune. So when you get strikes, even if details are still being clarified, the market starts asking one brutal question. If this spreads, how many barrels are at risk? That's it. That question alone can push prices. Now zoom out one level. If oil stays elevated, you don't just pay more at the pump, you pay more everywhere. Transportation costs rise, industrial input costs rise, food distribution costs rise. Everything that moves gets more expensive. That's why oil is not just oil. Oil is inflation in liquid form, and that matters for countries that import energy. If you're watching this from Pakistan or anywhere in South Asia, you already know this pain. Higher oil prices hit currencies, trade balances, and everyday cost of living. They drain foreign reserves. They weaken local buying power. They squeeze businesses from both ends. Higher costs, slower demand. So this isn't a distant headline. This is a pressure wave. Now stocks. When markets face geopolitical uncertainty, they don't try to be brave. They de-risk. Because uncertainty creates two immediate threats to equities. Number one, inflation risk through energy. Number two, growth risk through disruption. And when you mix inflation risk with growth risk, you get the most toxic cocktail for the stock market. Stagflation fear. Even the hint of it makes investors nervous. And here's the trap. Central banks hate inflation, but economies hate high rates. So if oil-driven inflation rises, what happens? The Federal Reserve gets cornered. If inflation starts rising again because energy is spiking, the Fed can't easily justify cutting. But if the economy slows because costs rise and uncertainty spreads, the pressure to support growth increases. That's the impossible choice. And markets hate impossible choices. Now let's talk Bitcoin, because this is where the narrative battle is happening in real time. Bitcoin believers have a thesis, a powerful one. They believe Bitcoin is digital gold, a hedge, a safe haven, a store of value when the world looks unstable. And in theory, a geopolitical shock should be Bitcoin's moment. So why did Bitcoin drop? Because in the first wave of fear, markets don't choose philosophy. They choose liquidity. When traders panic, they sell what they can sell. They reduce leveraged risk. They close positions. They raise cash. And Bitcoin, in 2026, still trades like a hybrid asset. Sometimes it behaves like a hedge narrative. But during sharp risk-off moments, it often behaves like a high-beta instrument tied to liquidity conditions. That doesn't kill the store of value thesis. It reveals the timeline. In the initial shock, Bitcoin can drop with everything else. But the second phase is where things get interesting, because wars and conflicts can become inflationary. They can expand deficits. They can push governments toward spending, and spending often gets financed in ways that increase monetary pressure over time. That's where the store of value argument tries to reassert itself. If this crisis triggers sustained higher energy prices, central bank constraints, and long-term inflation expectations, Bitcoin's narrative could regain traction after the initial sell-off. We've seen this kind of pattern before in other shocks. The first move is liquidation. The second move is repricing. The first move is fear. The second move is logic. So the key question isn't Bitcoin is dead or Bitcoin is safe haven. The key question is, are we in phase 1 or are we about to enter phase 2? And that depends on what happens next. Now I want you to focus, because what happens next is not a guessing game. It's a scenario tree, and each branch has a different market signature. Scenario 1, de-escalation. This is the best case scenario. Diplomatic channels engage, major powers pressure restraint, statements calm the market, and most importantly, the threat to energy flow fades. If that happens, oil can drop as fast as it rose, stocks can rebound, Bitcoin can stabilize, and the entire event becomes a violent spike in volatility that resets quickly. Markets love relief, and relief rallies can be sharp. But there's a problem. De-escalation only works if there is credibility, not just words, signals, actions, a pause in strikes, a reduction in threats, a clear message that the choke points won't be touched. Scenario 2, escalation. This is the nightmare branch. If strikes intensify, if key oil infrastructure keeps getting threatened, or if the Strait of Hormuz faces even partial disruption, oil doesn't stop at a 7% jump. Oil starts rewriting inflation forecasts. And once inflation forecasts rewrite, everything else follows. Stocks can correct deeper. Risk appetite shrinks. Credit markets tighten. And then we get the classic market reaction. Protect capital first, chase returns later. In that environment, Bitcoin can go two ways. In the immediate liquidity crunch, Bitcoin can drop as people sell risk. But over time, if inflation expectations surge and confidence in policy stability weakens, Bitcoin can re-attract capital as an alternative store of value narrative. That's the tension. Bitcoin is a liquidity asset in the short term. It wants to be a hedge asset in the long term. And this crisis is a live test. Scenario 3. Prolonged uncertainty. Historically, this is the most common. Not full escalation, not clean peace, just continuous tension. Headlines, counter-headlines, small attacks, defensive actions, markets swinging back and forth. This is the hardest scenario for most people because it causes decision fatigue. And decision fatigue causes mistakes. In prolonged uncertainty, volatility becomes the product. Oil moves on every rumor. Stocks move on every statement. Crypto whipsaws on every risk pulse. And the people who lose are the ones who trade emotions. So what should you watch? Not the noise. The indicators. Number 1. Any credible sign of disruption around the Strait of Hormuz. Even a hint of sustained shipping risk can keep oil elevated. Number 2. Oil benchmarks. If Brent and WTI hold high levels for days, inflation expectations start anchoring upward. That changes the rate outlook. Number 3. Central bank tone. If policymakers start sounding less flexible because energy inflation is back, risk assets feel the pressure. Number 4. Bitcoin behavior relative to gold. Gold is the old safe haven. If gold rises while Bitcoin falls, the market is telling you what it trusts in the moment. If Bitcoin begins rising while uncertainty persists, that tells you the narrative is gaining ground again. Number 5. Positioning and leverage. You don't need deep technical data to understand this. In sharp moves, liquidations matter. If leverage is flushed, the next move can be cleaner. If leverage remains high, volatility can repeat. Now here's the part people won't say out loud. The market's first reaction is often wrong on timing. Not wrong on direction, wrong on timing. Because markets don't price reality first. They price fear first. Then they price probabilities. Then they price outcomes. Right now, we're in the fear zone. Oil jumped, stocks slipped, Bitcoin dipped. But the real repricing happens when markets decide whether this is a one-week shock or a multi-month risk regime. And that decision is not made by one headline. It's made by patterns. So here's the cliffhanger you need to sit with. If Iran's strategy is to raise costs by pressuring regional assets and energy flow, then the market isn't looking at today. It's looking at the next step. Because the next step is where the real money moves. And the question is brutally simple. Does this stay contained? Or does it touch the arteries? Now I want to make this practical without turning it into do this, do that. This is educational analysis. The goal is not to tell you what to buy. The goal is to tell you what to understand. Because if you understand the mechanics, you stop reacting like the crowd. You stop getting whiplash by every red candle. And you start seeing the structure behind the chaos. Structure number 1, energy is the trigger. Structure number 2, inflation is the transmission. Structure number 3, rates are the amplifier. Structure number 4, liquidity is the breaker switch. Energy moves inflation. Inflation pressures rates. Rates tighten liquidity. Liquidity hits risk assets. And Bitcoin, whether people like it or not, is still plugged into liquidity in the short run. That's the circuit. Now zoom in on one detail that most people miss. When oil spikes, the shock doesn't land equally. It hits importers harder than exporters. It hits fragile currencies harder than reserve currencies. It hits households harder than institutions. And it hits developing economies in a way that doesn't show up immediately on American charts. So if you're in a country that imports energy, this story is not a chart story. It's a real-life cost story. And that's why these events matter even if you never trade oil and you never touch futures. Because inflation doesn't ask your permission. Now we need to address the psychological trap. When war headlines hit, people do one of two things. They panic or they tune out. Both are mistakes. Panic makes you sell the bottom. Tuning out makes you miss the shift. The advantage is staying calm while staying aware. And that's why I want you to think like a professional risk manager for the next minute. A professional doesn't ask, "What do I feel?" A professional asks, "What changed?" So what changed? The risk of disruption to global energy flow increased. Even if short-term details are still being verified and clarified, the market is not pricing perfection. It is pricing tail risk. And tail risk is what blows up portfolios when people pretend it doesn't exist. Now here's the second cliffhanger. If oil keeps rising, and inflation expectations rise with it, the next market victim may not be Bitcoin. It may be the idea that rate cuts are coming soon. And if the market starts pushing out rate cuts, risk assets across the board can feel it. That's the quiet killer. Not missiles, not headlines, rate expectations. So the next few days matter. Not because you need to trade every candle, but because the market is going to reveal its beliefs. Does oil fade quickly? Do stocks recover quickly? Does Bitcoin regain $66K and hold it? Or does the market act like this is the beginning of a new regime? Watch the behavior. Behavior tells you more than commentary. And now one last thing. A lot of people are going to argue in the comments about whether Bitcoin failed as a safe haven today. But that's a simplistic test, because safe haven behavior is rarely instant. Gold didn't become gold in a day. Narratives are earned over cycles. What Bitcoin is being forced to prove right now is not, does it never fall? That's unrealistic. What it's being forced to prove is, after the shock, does it recover with strength? After the panic, does it attract capital as protection? If it does, the safe haven narrative survives. If it doesn't, then Bitcoin remains primarily a liquidity-driven risk asset in the market's mind, at least for now. Either way, this week is a live experiment, and you're watching it unfold. If you want to stay ahead of this story as it evolves, make sure you're subscribed, because the next update is where we'll see whether this was a one-day scare or the first domino. And I want to hear your take in the comments. Do you think Bitcoin will eventually behave more like gold during global crises, or will it always trade like a high-risk tech asset when fear hits? And second question, be honest. Did today's drop below $66K surprise you? Or did you expect Bitcoin to sell off with stocks in the first wave? If this breakdown helped you understand what's really happening, hit subscribe, and you'll be ready before the next headline hits the market.